Hello and welcome to the MicroLearning Institute. In this tutorial we look at the fundamentals of IAS 38 Intangible Assets. IAS 38 defines an intangible asset as an identifiable non-monetary asset without physical substance. Examples of assets that might be classified as intangible include patents, trademarks, import duties, licenses and computer software. Goodwill and brand image are also examples of intangible assets which need to be identified separately before they can be included as assets of the business. IAS 38 states that an intangible asset must be identifiable. An asset is identifiable when it is separable and also when it arises from contractual or other legal rights. Motion picture films, fishing licenses and import quotas arise from contractual or legal rights. An intangible asset must be under the control of the entity, so the entity has the power to obtain the future economic benefits from the asset. This control will usually, but not necessarily, stem from legally enforceable rights. Expenditure on staff training courses may be expected to increase skills of the staff and to generate future economic benefit. However, the entity incurring this expenditure may have little control over the staff, who could decide to move to a different employer. IAS 38 states that an intangible asset should only be recognized if, and only if, both the following conditions occur. 1. It is probable that the future economic benefits that are attributable to the asset will flow to the entity, and 2. The cost can be measured reliably. IAS 38 states that intangible assets should be measured initially at their cost. The cost of such assets comprises the purchase price and any directly attributable costs of preparing the asset for its intended use. An example of the latter cost would be legal and professional fees. An intangible asset may also be acquired in a business combination. And if an intangible asset is acquired in a business combination, the cost of the asset is its fair value on the date of acquisition. With regard to internally generated intangible assets, IAS 38 has additional requirements such that the internal generation of an asset should be classified into 1. A research phase and 2. A development phase. With regard to the research phase, IAS 38 states that any expenditure that arises in the research phase should be recognized as an expense when it is incurred. The rationale being that there is insufficient certainty as to whether future economic benefit will occur. Examples of expenditure that arise in the research phase include activities aimed at obtaining new knowledge or the search for alternatives for material devices, products, processes or services. In contrast to the research phase, IAS 38 states that development costs qualify for recognition as intangible assets provided the following strict criteria apply. These criteria are 1. That there are probable future economic benefits, 2. That the entity has the intention to complete the asset and use it or sell it, 3. The entity has resources to complete the development technically and financially, 4. The entity has the ability to use or sell the asset, 5. The entity has the technical feasibility of completing the intangible asset so it can be used or sold. And 6. The expenditure attributable to the asset can be measured reliably. IAS 38 states that intangible assets can be measured initially at cost under the cost model and subsequently carried at cost less accumulated amortisation and impairment losses. The intangible asset can be alternatively measured under the revaluation model at its fair value less accumulated amortisation and impairment losses. In terms of accounting for revaluation gains and losses, The rules are identical to the corresponding rules in IAS 16 with regard to revaluation of property, plant and equipment. The useful life of an intangible asset needs to be assessed as either 1. Finite or 2. Indefinite. An intangible asset with a finite life needs to be amortized on a systematic basis over its life. The useful life of an intangible asset that has arisen from a contract such as a license or a patent cannot exceed the period of the contract or the legal agreement. The method of amortization, straight line or diminishing balance, should reflect the asset usage and be applied consistently. The appropriateness of the remaining life and method should be reviewed on an annual basis. Amortization of the intangible asset should start when the asset is available for use and cease at the earlier of 1. The date the asset is classified as held for sale under IFRS 5, and 2. The date the asset is derecognized. An asset with no foreseeable limit to the period or benefit to the entity can be classified as having an indefinite life and will not be amortized. The classification needs to be reviewed for every accounting period. Any changes in the expected residual value need to be treated as a change in an accounting estimate as per IAS 8. Thank you for watching this short tutorial on IAS 38 Intangible Assets from the MicroLearning Institute.